can see my screen, it is reflected. Then
everything is fine.
Okay, so let me start with the house price cycle and what is happening in housing markets in international community. What is happening in those slides, and please focus on the left hand side. Let me adjust my screen first. Yeah, and here it is. House price cycle. As you see, we have in house price cycle two important dates. One of them is this green line, 2008. Please focus on this 2008. We have, as you see here, we have months, okay? Meaning that the months in the year and the following 28 months, approximately. Let's say if we are in 2008, this side is for 2008 and this side is for 2009. Okay, so you can follow the graphs and the lines according to the schedule. So this green line showing that how during the 2008 crisis, global financial crisis, house prices down from their peak approximately 10%. And after the central bank taken measures in the 2009, the following year, the house price converged to its previous level. Okay, and in 2007, please look at the same date. During 1 year, please look at this side. During 1 year, our house price index approximately decreased 10%, and in 2018, 1 year later, it converged and compensate its 8% of losses and just finished the year as a 2% loss if we take a point of view from the starting point. So what we are dealing with today, this orange line, it is 2022, and in just 10 months, as you see in the orange line, we have approximately 9% decrease in the global house price cycle. And today, if we extend this chart, the house price still trying to decrease their previous level. What is the basic reason? So why the house price decreasing, especially during the crisis period, and what is the major and macro dynamics behind the screen? The basic answer for this question is this. In the normal times, if the interest rates is captured by the market expectation and the demand and supply condition makes an equilibrium in the market dynamics, bringing the house price demand and the house price supply in an equilibrium level in a smooth line. But when we confront a crisis, or when we confront a demand or supply side shock in the market, people have a worsening in expectation. What does this mean? If I say that for the Dr. Walchin, or let's say for the Ben Ibrahim, if I say that today, if you wanna buy a house today in United States, let's say it is $1 million in Texas, and the market is smooth and gradually compensate its losses, and the interest rate is just, let's say, 4% or 5% for the mortgage lending, then you can take a position because you expect that the house price will be compensate its losses which has been during the COVID crisis. But if I say that to you, because of the Middle East crisis, Israel and Palestine, another type of third world war like between Russia and Ukraine, there is a political and socioeconomic crisis in Middle East, and it has a possibility to widespread to the rest of the world, West and East. Let's say Russia, China, Turkey, India, Pakistan, and those countries are support the Middle Eastern countries, and let's say West is supporting the Israel. And this will bring another new crisis. Is there anybody who is today can pay the $1 million for the house and expect that this house price will rise? No, because everybody will convert their expectation that there will be a new crisis. Because of this crisis, demand will decrease, price will decrease. So maybe next year, I can buy this house 20% cheaper than today. So if I decrease my demand, then if Dr. Walchin also decreases demand, if Ibrahim decreases demand, and if all households decrease their demand for the house in the United States, then all the houses at hand couldn't be sold. So their price started to decrease because there is no demand. Because demand decreasing, Dr. Walchin not buying house, I'm not buying house, Ibrahim is not buying house, then the prices start to decrease gradually. Then this will convert the house price dynamics in the market equilibrium in a new condition, like in the green line, like in the orange line. And after this crisis, if I warn the people that there is a negotiation between Israel and Palestine, and all political crises will be solved in just 30 days. What will happen now? I expect that because this crisis pass away, then lots of people want to buy a new house because they expect the house prices will be rise. Then everybody started to raise their demand. Then the prices will be compensated their losses, like in this second part of this graph. This is especially happening during the crisis and after the crisis period, ex ante, ex post period of the crisis. And on the right hand side, please look at the screen on the right hand side of the chart. This chart showing us auction clearing rate and house prices, meaning we are making an auction, let's say, for the houses, and what is happening on the left hand side on the blue line, I have the auction clearance rate, and on the right hand side I have the house prices. Because the auction clearance rate decreased approximately from 75% to 45%, the house price following the same chart and has a huge correlation between auction clearance rate and the house price index, then it is starting to decrease. What I should see here, I should see here this line. Here, may I request something? I think people on the screen are moving their mouses on the pictures, and because of that reason, on the line, as you see here, I have some problems. For that reason, please, during the presentation, don't move your mouse. If you have any type of question, please ask those questions directly to me, and I will try to answer all those type of questions in your mind, and we can easily solve if you have any question on the chart as well. If you move your mouse, the pictures and the numbers are blurring on the screen, and I couldn't follow what I should speak about those issues. Then, please look at this side of the chart. As you see, auction clearance rates started to increase. So what should I expect? The house price index from there down will reach a recovery period and will reach approximately to 3 or 5% in the next couple of weeks or months, because auction clearance rate and the house price index has a huge correlation. And if the auction clearance rate started to increase, then the house price will follow it. Okay. And on the left-hand side, please look at this housing starts. Okay. Housing starts in million on the left-hand side. And as you see, this gray line, this gray dash line, are the recession period in the history. For instance, we have here Gulf crisis. We have here dot-com crisis. We have here global financial crisis in 2008. And in the thin line, we have here COVID crisis. Okay. And if you follow the house price and housing starts, how can I say that? How many houses started to build up in your country? This is exactly measuring this index. And during the crisis period, during the recession period, the house starts is decreasing sharply, as you see in the picture. House starts decrease sharply. House starts decrease sharply. As you see, house starts decrease sharply. And if we pass away the crisis period and recessionary expectation in the market, then we can easily understand that we will start to recovery period. We will start to increase in the house starts and decrease in the house prices. Okay, because during the crisis period, also there is no new house starting to build up. For that reason, there is no supply in the market. The house price can also be increased during the crisis period. And on the right-hand side of the chart, in the second chart, I have housing affordability index. What does this mean? This means that I'm dividing the house price to average income in the country. And this is showing how a person, average person, can afford to buy a new house or not. Okay, this is a house affordability index. And on the left-hand side, as you see, I have numbers. If there's a upscale, if there's an increasing slope here, I have more affordable homes to buy. And if this dash line, this line graph decreasing smoothly, now I can easily say that there is a less affordable home in the market. And today, as you see, from the 108 level, the house price affordability index decreased to approximately 100, meaning approximately 30% decrease from the affordability of the average person when we compare to the beginning of the COVID crisis. So if we can adjust our schedule today, people can have an ability to buy less home when we compare to crisis period before. Okay, before the crisis period, people have more capacity to afford a new house, but today they are not buying a new house because of the prices and because of the decrease in the interest rate during the COVID crisis. Because we have lots of cheap money during the crisis, we have lots of enough liquidity with less mortgage rates, and people buy those homes. And today those houses are high and expensive, and people are less affordable to those houses. And in the second chart, please look at, here I have the days, okay, the days showing that working days in a day, in a year, I have 365 days in a year, but working day, meaning that in a week, I have 5 working days from Monday to Friday. In a year, I have approximately 252 working days, okay, for a stock exchange. And the 0 point is the starting point of the year. For instance, if I focus on a line for, let's say, this purple line, here I have in 2000, here I have 1999, and here I have 2001. Okay, and this starting point is for the 2000. So what can I say in this graph? S&P performance around the last rate hike. What does this mean? You know that S&P 500 is collecting 500 biggest company in the United States. And they are making an index showing the index performance of the 500 biggest companies in the stock exchange of the United States. And as you know, the interest rate hike and the S&P performance or any type of stock exchange performance has a negative correlation. What does this mean? Please, everybody, all attendees, focused on these sentences. If the interest rate decreasing in the market, the money looking for an alternative investment way. If Dr. Walchin has $1 million and if the banks offering him rather than 10% deposit rate, if the bank offered to Dr. Walchin saying that the Federal Reserve decreased the interest rate because of the crisis and we can offer only 1% of deposit return during 1 year, what will Dr. Walchin ask himself? He will ask that, if I put my money into the bank, just a deposit, it will give only 1% return during the 1 year. And maybe the inflation will be the 2%. So my real return will be minus, because investors always focus on the real return on their investment, not the nominal return. And to find the real return, I will adjust my nominal return according to the price indices, inflation rates. So if the interest rate decrease, Dr. Walchin asked himself that I should find another investment tools to earn more money because the banks only give 1% to me, right? So if the interest rate decrease, S&P performance will be rise because everybody will buy a new company in the stock exchange. But let's think the reverse. If the interest rates started to rise, if I ask Dr. Walchin the same question, if the Federal Reserve bring their federal funding rate to 6%, then a basic trading commercial banking can offer you the 10% deposit return. Can Dr. Walchin take a new risk in the stock exchange, in a risky asset, in a volatile asset, to earn just 12%? No, because he knows that banks will give in a 100% 10% return at the end of the year, right? So Dr. Walchin will never buy a new stock like Apple, like Amazon, like Microsoft in the stock exchange. Because of the interest rate is really high in the market, the stock prices will start to decrease. Okay, you can think the interest rate, international financial market, and equity returns in this way. And on the right-hand side, I have Morgan Stanley MSCI index. This is Morgan Stanley comparable index, world earning growth and price return, year-on-year percentage changes, meaning that in 1 year, how much a world stock exchange get a value in price return and the earning. What I mean by earning? Earning is this. If I buy the Apple stock in the stock exchange, if I buy the Apple stock, if the revenues and net income of the Apple increase at the end of the year, the price of the Apple will increase surely, because everybody will try to buy a profitable company, right? If Apple produces a net profit at the end of the year, if their earning increasing, so the price of the Apple stock will follow it, because everybody expecting that, because Apple produce a revenue and net profit in their balance sheet. So if I buy this company, when the Apple distributed and allocated their profit to their shareholders, as an investor, I will take my share as well, right? As a dividend yield. For that reason, earning and price return has a huge correlation in the market. And as I see here, the green line, the earnings, sharply decrease during the COVID crisis. Then now the price returns started to increase because everybody expecting in the market that the earning will be compensated and recover their losses, which happened during the COVID crisis. And on the left-hand side, which is a really, really important indicator for all of us, prices of oil. In the Brent oil, this is not the West Texas, this is not the VTI, this is Brent oil, and the price is USD per barrel. Okay, and as you see here, please look at this sharp decrease. From $140 per barrel, the prices of oil decreased to just $40 per barrel when in 2008 crisis, right? There is a global financial crisis in the market. There is no demand, there is no production, so the prices of oil decreased sharply. What happened here? We have a huge, sharp recovery in the European Union because of the debt crisis in Greece, in Spain, and in Portugal. And the oil prices decreased sharply. And what happened here? Look at this, from the $80 per barrel, the prices decreased to just $10 per barrel during the COVID crisis, right? Nobody even couldn't enter their car and change their city. No oil consumption, no oil demand, no Brent, no crude, nothing. So the prices decreased. And after that, especially from year to year, when the Russia and Ukraine enter a war, all countries around the world suppose that Russia will cut all oil supply to the rest of the world, and because of the supply restriction, the prices reach approximately again 130 per barrel. But today, after the West, especially the European Union, solved their natural gas and the Brent oil issues, today we have an equilibrium in oil prices around $80, but the expectation for the next couple of years, the oil prices will reach again $120 per barrel, because commodity market always in a cycle, up, down, up, down. Okay, this is a cycle. When the demand decrease, when the production and growth decrease, the oil prices started to decrease. When the people started to increase their demand for oil, when the companies started to increase the derivative for oil to produce their output in their factories, okay, then the oil prices started to increase again. And please look at the second chart here. There's one. In this chart, what I have the prices of natural gas, especially in orange line. Okay, the prices of natural gas. What happened here? What happened here? And natural gas from approximately 50 euro per megawatt to 300 euro per. What happened here? Here, the United States and Western countries, all European Union countries, put a sanction on Russian natural gas market. And nobody imported any natural gas from Russia. So then Russia cut all their production from natural gas to the rest of the world. What happened? Always, in this type of condition, you should always think demand and supply. If the supply decrease, price increase. Okay, if the supply decrease, price increase. So if the Russia cut all their pipelines, all people remember the memes and caps. There's a picture here is the Russia. They are closing this one, and in the picture, all the Western Europe is icing, right? Because all European Union countries using the Russian natural gas, and to even cooling, even heating their home, they are using those natural gas. If those supply decrease, you can be ready to even $1,000 to heat your home, right? Because the supply is cut, and you should be heated in your home. For that reason, the prices reach their peak level. Then, when the Western countries find alternative ways from Iran, from Azerbaijan, from the Gulf countries to bring their natural gas, then the prices turn their historic average levels, like here in 50 euro. Okay, but please, think that you are a speculative investor in the stock exchange, and you are taking a position for $1 million in the natural gas derivative market, okay, future market. You are saying that in 1 month, I expect that the natural gas prices, because of this war, increase. And you are putting $1 million. Just in 1 month, your money will become $7 million. Okay, your $1 million becomes $7 million just in 1 month because of the crisis between Russia and the Western Europe. Okay, so investing is this. Sometimes you are paying the long game, but sometimes you can be a speculative investor. Okay, you can take a speculative position in the market, and you can get a huge gain at the end of this position. And here I have the government bond yields, because our title today, our main topic is fixed income. When we speak about, sorry for this, when we speak about the government bond yields, we are speaking about the fixed income securities. What does this mean? Fixed income means whatever happens in the market, this government will pay this money to you. There is no risk. Okay, if we are speaking about the fixed income securities, we are speaking about treasury bills and government bonds. Government bonds means what happens in the market, it is not a problem. This government will pay this money to you, right? There is no bankruptcy in the government. Companies can go to bankruptcy. Banks can go to bankruptcy. But even lots of crises, Argentina is still there. Ukraine is still there. They are paying debt to the rest of the market. So if we are speaking about fixed income securities, we are speaking about the government bond yields. Okay. And here, as you see, normally in Western and the developed market, government bonds has a really low return because of the low inflationary outlook in their market. Especially in Australia, look at the charts, just the 1% return. And look at the Japan. Approximately during 15 years, Japan has only 0% of government fixed income securities. Why? Because it is a secure country, because it has a low inflation, because it can pay any debt if you buy the position there. So there is a huge demand for the Japanese government bond, and their return is really low. But what happened here? What happened here in this picture? In this picture, there is a huge interest rate hike in the developed markets because of the quantitative tapering period, and because of the short-term interest rate, like 1 week repo rate, increased approximately to 3 or 4%. Now I can see those return as well. Even for government securities, government bonds, treasury bills, those fixed income securities can reach approximately 3 and 4% level as well. Hang on a sec. There is a question in Abdul Lamin Kamara. Isn't due to war inflation? Exactly. the topic we speak a few minutes ago about the natural gas prices and oil gas prices, it is coming from the war inflation. Because of the war between Russia and Ukraine, those countries are the producer of the commodities in the world. What we mean by commodities? Wheat is a commodity, soybean is a commodity, oil is a commodity, metals is a commodity, iron is a commodity, steel is a commodity. All these are the commodity in the market. Okay. And if the Russia and Ukraine, for instance, Ukraine is the one of the largest producer of the wheat, right? You need wheat to produce your bread. So if there is no wheat in the market, the bread prices even rise huge levels. Okay. For that reason, we are calling those dynamics as war inflation, because there is no supply, the prices will go up, inflation will go up. Thanks for the question, Abdul. And here on the right-hand side, please look at this inflation expectation. And this gray line is United States, the dark blue is Eurozone, and the light blue is Japan. And this 5-year inflation swap rate. What we mean by 5-year inflation swap rate? I mean here that if I take a position here, what will happen to my investment because of the inflation outlook? Okay, what will happen to my investment because of the inflation outlook? So what should I expect from the market to give me to compensate my inflation losses because of my investment? So what can happen here? I can directly say that if I take a position here in United States, at least for 5-year inflation, I need a 2.5% of real return, nominal return, to compensate my inflation losses. Okay, this is the break-even point for inflation swap line. And here again, I have the nominal yields in government fixed income securities. And in these fixed income securities, I have the 10-year government. This purple one is the investment grade. This is like investment grade countries. This is high yield bonds, meaning that this is not government bonds, but this is high yield bonds. These are a little bit risky asset. These are not just government bonds or treasury bills. For instance, Amazon can even pay a bill or pay a bond for their investor. But Amazon is not United States. Amazon can go bankruptcy one day, but United States is not. Okay, for that reason, United States incomes and securities fixed income return is low, but the Amazon return in fixed income is high. For that reason, we are calling these securities as high yields return. Okay, and this is the emerging market. Because the emerging market is risky when compared to the developed market, we are saying that, look at this one. Where is the Japan, Germany, Australia, United States, United Kingdom return? It is just 2%. But where is the emerging market return? It is just around 6 and 7%. Why? Why the developed market return is 2-3%, but why the emerging market return is 6%? It is because of the risk. Okay, emerging market is risky. For that reason, I need to increase my return to compensate my risk in their investment. Okay, so if a country is risky, it should recommend me, it should offer me a higher return to compensate my position in investment to take a risk. Okay, and here, this is a spread issue. This is a little bit detailed issue. I will cover this topic in next week in fixed income and collateral issues as well. But please look at this chart. Real United States Treasury yield. What does this mean? Please keep in mind always. If I speak about the real yields means I have a yield. Let's say Dr. Walchin put their money in the bank. And let's say this bank give a return 10% to their money. If I ask Dr. Walchin, what is your real return? And if Dr. Walchin say that I get 10% return from the bank, and this is my real yield, this is not correct. Because the 10% is nominal yield. But during 1 year, we don't know how the purchasing power of the Dr. Walchin increase or decrease. Because of the inflation, maybe 1 year ago, Dr. Walchin with his money can buy a house, but today the house price increased 10%. Can Dr. Walchin get the same house in the same money? No. So I should adjust my nominal return according to the price changes. And the price changes is consumer price inflation. Okay. So if I minus my nominal yields from, if I decrease my inflation from the nominal yields, I will reach the real yields. So nominal yields minus inflation will be my real yields. And as you see, during the COVID crisis, all the United States Treasury yield has a minus return. Can anybody buy position in this market? No, because they know that their real return at the end of the year will be minus, negative return. But investor always look for the positive return, right? Net return. But here I have a minus return. I'm losing money. I'm putting $1 million, but at the end of the year, they are giving me to $950,000. 5% losses. Okay. Nobody take a position in such a market because of the negative return. And here I have the US 10-year Treasury yield. And this blue line is real yield. This orange line is nominal yield. And this dark blue line is my break-even yield. What does this mean? Here, in the nominal yield, I'm here. Okay, approximately 4%, 3%, 4%. And my real yield is just 2%. So the rest of 2% is my break-even. What does this mean? It is the loss because of the inflation. So I request from the governments of those countries at least this type of return, even the inflation rate goes down to zero. What does this mean? This is the break-even yield for me. Break-even point to decide whether take a position in this market or not. And here are what I have: global investment grade credit. And in Europe, in Australia, and in United States, please look at this. By the way, this is basis point. Okay, this is just basis point mean 200 over 10,000. Okay, so small number. This 200 does not mean 200 percentages or point. This is basis point, 0.02. Okay, 0.02 mean. And US investment grade credit return composition. And this is coupon spread total return. What does this mean? If Dr. Walchin buy a United States government bond for 10 years, each year United States offer to Dr. Walchin each year pay a coupon payment. Okay, what does coupon payment? At the end of the year, Dr. Walchin, let's say, get 10% yield because of its coupon in the bond market. Okay, in each year. And this is showing in gray line. This dark blue line is showing the price changes of the bond yields. If the interest rate increase, the price of the bond will decrease, or vice versa. If the interest rate decrease, the price of bond will increase. This will be my return because of the price changes. And this purple line will be the spread return because of the risky asset, because of the riskless asset. And this rectangle, light blue, will be my total return. And investment grade credit return will be around 15% for me for the 2023. Okay, but today, last year, I lost my money approximately 20% in the investment grade companies. And I will cover this one as well in the next topic in the collateral issues and international money market in the next week. But I want to show you this emerging market bond yields, yield to maturity. This one is showing the yield to maturity. What does this mean? How much yield I will get until the maturity. Let's say Dr. Walchin take a position in 10-year treasury bond, and after 4 years, how much return he will give? Because after 4 years, I have 6 years yield to maturity. Okay, 6 years yield to maturity. Maturity means 10 years. I have maturity for 10 years. From the beginning, at the end of the 10 year, this 10-year period called as maturity period. And if I take a position in the 4th year, from 4th year to the 10th year, I have 6 years. And this is yield for 6 years. Okay, yield to till the maturity. And as you see, corporate United States, sovereign bonds meaning government securities. Corporate bonds means like Apple, Amazon, and Microsoft. And as you see, always the corporate bonds, normally corporate bonds offer higher return than the sovereign bonds. But as you see, especially during the crisis period, I have less return in corporate bonds than the sovereign bonds because of the increase in the interest rate of the government yields. Okay. And on the right hand side here, real 10-year government bond yields. And here I have my country, Turkey, huge real negative return because of the inflation. The government bonds return is approximately 35%, but today official inflation in Turkey is 65%. And the real return is negative because of this inflationary outlook. And here, as you see, the Brazil and Latin American countries or the emerging market has the highest return in their local currency real government bond yields. Okay, for that reason, if you are trying to take a position, you should take into consideration risk, inflation, and the FX appreciation, depreciation issues in the emerging market issues. But during this period, 10-year government bonds give the best return in Brazil, South Africa, China, India, and Indonesia. Those are the BRICS countries, right? BRICS, Brazil, Russia, India, South Africa, and China. And those are the best return countries in their 10-year government yield because of the low inflationary outlook and because of the growth and production increase in their GDP. And the last slide from my side. Here I have asset classes. Fixed income is the today's topic, the orange line. The alternative investment and the equities. Equities meaning stock exchange like Apple, Microsoft, Alibaba, Amazon, those type of companies, equities. Fixed income is government securities, and alternative investment I have. And please look at, in the global transport, I had the highest return in the 1-year return, approximately 11%. And if you look at the Australian 10-year return fixed income government securities, it is just 3%. If you look at the United States 10-year, it is just 3.5%. But if you focus on the global high yield bonds, it is 5%. So